thank you all for joining us today. Hopefully, we're here to talk about the appraisal and liquidation world and what it kind of looks like now after, or actually during, the coronavirus issues. And we have with us Ryan Davis and Chad Farrell from Tiger, and they're going to talk a little bit about that a little bit today. And we're also going to chat with Chad Z from Armanino to discuss what the changes are in the valuation services that are out there, and kind of how they're being affected by the whole coronavirus or the COVID-19 impact as well. But first, I think we wanted to introduce ourselves. So if you don't mind flipping over the next slide, I think we'll give myself and the firm a little bit of a plug. I'm with SierraConstellation. We've been around now for about 7 or 8 years. And we started in LA, but now we've kind of grown to Boston and New York, Houston, Dallas, Seattle, and we're more of a nationwide firm now. We're a generalist and work on a number of various engagements. Currently, the ones we could talk about, I guess, which were publicized, were Pacific Ethanol, MedMen, Norpac. I'm not sure if one of them's ethanol, and actually it makes hand sanitizer. So sales of it have actually improved from the hand sanitization business a little bit. Not quite enough to go and deal with ethanol issues, but at least it's improved a little bit to give the company some benefit. And we're also working on frozen foods and a variety of other companies that are out there. I think currently we've got 26 engagements that we're working on currently. And I've got about 25 years of experience. It says I'm getting to be an old guy. It's terrible. But that's kind of like what we do, what I do, and what our firm does. And what I'd like to do for each of the other panelists is to have them talk a little bit about themselves and where they're currently at in their experience. So if you don't mind, Ryan, can you tell us a little bit about what you're doing over at Tiger?
Yeah, absolutely. Thanks, Winston. So first of all, everyone probably knows Tiger, but I'll give a quick synopsis there just in case. We're one of the big 4 liquidation firms in the industry and appraisal firms. Publicly best known for a lot of our big retail liquidations because those are the things that make the news. But we also do equipment liquidations, wholesale liquidations as well, and we have a very sizable appraisal shop as well. And I've been at Tiger for almost my full career. I've been at Tiger for almost 15 years now, and have worked in almost every aspect, both in the liquidation and the appraisal side. And today I run the appraisal division in totality at Tiger.
And then Chad, you want to tell us a little bit about yourself?
Yes, thank you, Winston. So I'm the managing director at Tiger. I run our commercial and industrial practice. We've got a team located across the country doing auctions and liquidations.
Hold on one second. I don't know how to shut those. Oh, here it is.
Okay, so just a little bit of background on what I do at Tiger and my team. Obviously, we work closely with Ryan and other groups within Tiger. My background is I've spent the past 20 years doing industrial auctions and liquidations across a number of different verticals across the globe, more focused here at Tiger in North America. Prior to really getting involved in the auctions business about 20 years ago, I started out my career as an engineer out in the oil field, working out on drilling rigs and also in manufacturing plants for a company called Cameron Iron Works. They're a big oil field services and manufacturing company. And then after a few years there, I left and joined Ernst & Young and was in their performance improvement practice before entering the auction business in 1999. So that's my background. Really pleased to speak with everyone here today.
And Chad Z, can you tell us a little bit about your role at Armanino?
Sure. So I'm at Armanino, which is a consulting, tax, and audit shop, but we have a separate corporate finance and restructuring group that's actually based out of Southern California. And I am leading the transaction advisory service practice from the M&A due diligence side of things. But my background also consists of interim CFO advisory, working with portfolio companies, and have done a fair amount of turnaround and crisis management. I'm one of the members of Armanino's rapid response team in terms of the COVID crisis, and on an executive on the liquidity management team. Overall, I've got about 25 years of experience, most of it heavy in the M&A space.
Okay, great. And then if you don't mind, can we flip over to page 4 and have Ryan talk a little bit about the state of the industry?
Yeah, thanks again, Winston. So first of all, thanks everyone for giving us the opportunity to chat here. Certainly it's, and I know everyone keeps throwing around this term unprecedented, but it really is unprecedented. And here's what I mean by that. So we've all seen downturns before, right? Like we've seen the credit crisis, we've seen huge waves of liquidations before, but in those times, here's what we didn't see: is we didn't see a full shutdown of almost any industry like we have today. So certainly we've seen pullbacks in the past, but we haven't seen what we're seeing today in terms of the spigot being turned off in so many different places all at once. So it's unprecedented in that the slowdown is, and the shutdown is unlike anything we've ever seen. So there's some really big questions that come from that, right? Like huge questions. And certainly we have answers for some of them, but not all of them. And I'm going to give you kind of what our high-level thoughts are. And I'll probably talk for a solid 5-10 minutes here. But I would say if there, as I'm talking, if there are questions that come up that you'd like me to answer, if you just type them into the Q&A section of this, Winston can see your questions, and we can go through any open questions after I give just a brief summary of Tiger's perspective here. So, we are, as you would imagine, as appraisers and liquidators, we're getting a lot of the same question, which is, what is going to happen to values, right? Where do I predict values? What's going to happen to my NLV? Is it going down? Is it going way down? Are my goods liquid, or are they illiquid at this point? And again, unlike the previous times where we've had downturns like this, the answer is far less known today than it was then. It's far less predictable today than it was then. But we believe this is going to be a relatively short-term period where it's going to be unknown, and then it's going to firm up. I'll define that a little bit. So if you had asked any of the major liquidators in January or February this year, prior to the COVID crisis, if you had asked us to bid on a pool of assets, all of us would bid on those assets in a very, very tight spread. I mean, that's how good, not just the liquidators, but that's how good our ABL community in general has gotten at valuing assets. We have, over the last few decades, we've gotten ridiculously good at being able to predict the outcome of liquidations and asset sales. If you asked the four of us today what a certain pool of assets is worth in the next month or two, you're probably, like, to the extent that you get a firm answer, you're probably going to get a pretty big spread in what those answers are. And the reason for that is because the tried and true methods of disposing of assets are not available to us today, at least not in full scale. So retail liquidations, of course, not fully available because so many stores are closed down. Wholesale liquidations, also not fully available because wholesale operations are scaled back. The channels to whom you would sell them, right? Like, for example, if it's consumer goods, the channels to whom you would sell the consumer goods are dried up, right? For example, if you're selling to TJ Maxx, TJ is closed for the time being, or canceling POs for the time being. So a lot of the normal disposition channels are closed up, which means the predictability of the outcome is unknown right now. But that's only going to be in this shutdown period, right? And that's why we think there is going to be a relatively short period of uncertainty. And then what's going to happen as the economy reopens, more likely in dribs and drabs than in totality, but as the economy reopens and as assets start trading again, that's when asset values are going to really firm up, and we'll know what the true impact is. So we don't know exactly, at this minute, we don't know where exactly, like what the changes to values are, but we know directionally which way they're going, and we know which categories are going to be impacted the most. And the reason why we know them is because the economic forces that are the underlying drivers of value are still the same today as they were 6 months ago. It's just the economic forces have been wildly distorted for some categories. And I'll give you a couple quick examples. Right? Actually, what I'll talk about is those big economics forces. So the three big forces that drive asset value is, one is whether it's a discretionary good. And so consumer staples, for example, as we're going through this crisis, consumer staples, everyone hears about in the news, they're selling quickly, right? Take the obvious one, toilet paper, it's a consumer staple. It's selling out ridiculously fast. Your basic foods also selling fast, and on and on. Your consumer staples, they're selling ridiculously well. Highly discretionary goods, take like the most discretionary good you can think of, probably high-end jewelry, maybe is a discretionary goods, high-end automobiles. Those are the items that you have to expect a reasonable pullback in demand. So the first big factor that we're looking at when we're classifying which categories are going to be impacted is whether it's subject to changes in discretionary spending. Not whether it itself is discretionary, but whether it's subject to changes in discretionary spending. The second is whether the supply chain is stable and certain. So take goods that are made in America. Again, toilet paper, for example, is for the most part made in America. So though there is a short-term stock out of it in a lot of retailers, the supply chain is fairly stable and it'll be back in stock very, very quickly. Goods that are made overseas, the certainty of getting those goods is much lower. So the more stable a supply chain is, the firmer the values will stay. The less stable the supply chain is, the more likely there's going to be impact. And then finally, the other big factor here is if it's seasonal. And again, I'm going to use apparel. This is like the worst possible category, for example, apparel, which is your seasonal goods. You have a double whammy impact. You're going to be overweighted in spring goods because they did not sell to their full extent, and you're going to be underweighted in summer, fall because the supply chain has been disrupted. So both in wholesale and retail, both apparel and other seasonal goods, there's going to be a very long lag between right-sizing the inventory and firming up the supply chain and getting back to a place where a business's inventory reflect what consumers want. So what we did in general is we took these three major factors and ranked virtually all of the major asset classes that we appraise, and there's about 30 of them there, and there's a link on the page here. I don't know if you guys can click on the link or if you have to type it in, but there's a link on the page here on our website where we rank all of the asset categories that we appraise with the intent of, again, maybe not fully quantifying how bad the impact might be for certain categories, but certainly flagging the categories that are going to be most impacted by this. The other thing that I should just mention, because I keep getting this question, is are we still doing appraisals? The answer is absolutely we are. We've always kind of had a contingency plan just in case in terms of people working from home. So operationally, we were able to very, very easily convert from working in the office to working at home. Tiger, I'm sure like many of your organizations, is very, very team and collaborative, or team-oriented and collaborative. So there's a certainly from a morale perspective and from an interactive people perspective, we don't have that same benefit of seeing our coworkers every single day, but we are certainly able to value assets today. We're getting, as you expect, we're getting a lot of questions about how we do that. And what we're doing right now, in the lack of certainty for today's values, is rather than giving a pure NOLV, like what is your NOLV today, frankly, we can't do that, right? Because the assets need to be trading again before we give true NOLVs. But we are able to gauge, to the extent that a business is open, we are able to gauge directionally which direction the NOLVs are going and whether it's going to be a material or immaterial impact. So we are still doing our jobs, we're still valuing assets, and really what we're doing a lot of the time is sometimes what I would call like a light appraisal, where maybe we don't give a full NOLV, but what we do is assess for lenders the health of the inventory. is one of the critical things that's going to come out of this is not just that the sales are going to be there when the market reopens or when the economy kind of turns back on, if you will, but what is the health of that inventory when the company comes back to work? Have they been selling all their best in dribs and drabs over this period? Are they maintaining a supply chain for the best inventory, or are they really creaming their inventory between now and when the economy reopens? So that, I think, is probably the number one thing that we're doing for most clients. I'll pause there and just see if there are any questions.
I don't see any questions on here, but what I think I'd like to ask you a couple, if you don't mind, Ryan. The first thing is, when you take a look at when things come back, how do you see the spring apparel inventory liquidating out? I mean, we've got a couple clients of ours that are apparel manufacturers, and I'd like to know the answer to that.
Sure. Well, I will say I do believe apparel is probably the most impacted category. And I'm seeing, so what we're seeing right now, for example, with e-tailers that are still operating, is they are actually taking their open POs and cutting prices by as much as 70%. And this is currently operating businesses with open POs. That's how draconian the short-term impact could be for some apparel. What we are seeing, however, is the retailers that can afford and their balance sheet to hold assets, we're starting to see retailers make the decision now to pack away goods and keep them for next spring. In fact, I think there's one or two major retailers that made that announcement in the last couple of days as well. I think in the very short term, the apparel secondary market is going to be flooded. That's going to be caused by just a variety of factors, right? Take your major retailers not being open, take your secondary channels, Ross stores, TJs, et cetera, shutting off POs for the next few months. Between those two, you've now shut down the major, the artery, if you will, for apparel sales. So I think the very long short here is the sellers that are able to pack away goods and not have to close them out in the next couple of months are probably the ones who are going to do the best. Because if you're selling into the market in the next couple of months, you're going to be competing with a tremendous amount of other sellers that will be desperate for cash.
Okay, I've got a couple questions here. One of them is, assuming there aren't any retail liquidations going on right now, when we come out of the quarantine, will an abundance of liquidations further hurt liquidation returns?
That is almost undoubtedly going to be the case. Certainly there are a number of retailers that I would say are teetering at this minute. And I would say it's very likely that the latter half of this year, Q3 and Q4, is an extremely active retail liquidation market. And as we've all seen before, when the retail liquidation market gets hot, or when there are a lot of retail liquidations going on at the same time, consumers get numb to that concept. Or maybe numb is an overstatement, but they just don't respond to a going out of business sale as aggressively as they would when there's just a handful going on. When you walk into a mall and there's a multitude of liquidations, they seem far less special than when there's just one or two. So yes, it will very likely impact, at least in the short term, at least for the balance of 2020, it will impact retail values.
Okay. And what percentage of retailers do you think will make it through the COVID crisis?
Goodness gracious. It's a good question, and it's one that I'd love to be able to answer. But I actually don't think, I think the answer to that is more contingent on the government than I'd like it to be. So I don't think this is as much about retailer health as it is about the packages that go on. And let me qualify this a little bit. Right, a couple weeks ago, maybe 3 or 4 weeks ago, when the shutdown was really happening, it looked absolutely horrendous for asset values and for liquidations. The programs that have been put in place by the government seem to have, as far as we could tell, kicked the can down the road. Probably for the best, right? I'm not an economist, I can't opine on these things. But largely what I'm seeing is delays in decision making. We're certainly not seeing a lot of decisions being made at this minute to shut businesses down. So one, at this minute, it's hard to predict because there's a lot of like delayed decision making. And two is we don't know what might come next. So there could be another wave of government support that might keep more businesses operating. So, you know, trying to predict proportion of liquidations is less about predicting or less about understanding the health of retail and more maybe about predicting what the government might do. And that's, you know, I'm just not good at that. I don't know what the government's going to do next. So unfortunately, I can't give a solid answer to that one. Sorry.
Okay. That's okay. I can't give a solid answer to a lot of things, especially a question my wife generally asks me. But okay, well, I appreciate that. Do you mind if we move on to Chad Farrell and have him talk a little bit about industrial liquidations?
That's great. Thank you, guys.
Great, thanks, Winston. So super happy to share our thoughts today. Within the C&I group at Tiger, we certainly focus on execution within our group and doing transactions. So I have a few topics here to discuss based on kind of what we're seeing in this current market and current environment. You know, I'm getting asked a lot of questions, just like Ryan, are buyers and participating in auctions? Is it possible to run auction sales and liquidations? Are they still taking place? They certainly are taking place. We've done 3 auctions in the past 4 weeks. Buyer participation was pretty strong, and in a couple of verticals that we've done, the prices seem to hold up pretty well, and I'll talk about that here in a little bit. You know, one thing to note is all of our auctions that we're doing now are online only, obviously for health and safety reasons. Live auctions or in-person auctions, we don't think are going to be a transactional channel here for a while. And certainly some of the state auction commissions have suspended live auctions. The state of Louisiana has banned all live auctions and have forced all auctioneers there to go to online only. But they are still taking place. Online auctions have been around for a while. I'm sure everybody's seen them, and they're very effective in selling assets. A couple of things that we are seeing in the environment, you know, it's taking buyers after they buy something at auction a little bit longer to pay. People are managing their cash flow very closely on the buy side. And we have seen a couple of buyers who just couldn't pay their invoices. Their lines of credit had been cut, or they just didn't feel like they had the money to complete the transaction. It's a very small percentage, but that's still out there and stuff that we're managing very proactively as we go through our sales. Another thing that we're doing here is we're offering much longer lead times for buyers to remove equipment from plants or yards or locations. There's a number of reasons for that. One is, you know, just managing the trucking. You've got stay-at-home orders, but it's also due to health and safety concerns, which I'll talk about here next. So that's certainly the number one priority is health and safety and making sure people aren't getting sick. One of the reasons we're doing online only auctions. We put in procedures in early March for our auctions following CDC guidelines to help protect both our teammates at Tiger and our customers and clients. A couple of things that we have done that we've put in place is our team's working completely remotely from home. That's across the board at Tiger, but certainly something we're doing within the commercial and industrial group. So that's 100%, everybody's doing that. We do have some people doing the setup and removal at the sites, and we've got procedures in for that. Sometimes that's company personnel, maybe a Tiger person or two doing that as well. But we are doing that. We're limiting people to go do inspections by appointment only. We're practicing social distance, and we're doing the same thing with removals, where we want to make sure that people are staying safe. So we're limiting the number of removals and the number of buyers on site at any one time. The other thing we're doing is bringing gloves and masks and wipes on site. And so we're taking all of these kind of precautions and have a written procedures on how we do this to try and ensure the health and safety during the COVID-19 crisis here. One of the things that we're looking at doing is putting drones on site at some of the plants that we're helping to sell. to kind of manage a little bit more on the inspection side of it. We certainly have used drones in the past for marketing materials. So something we're looking at putting in place to do a little bit more remote work to help keep people safe and healthy.
Nick, can I ask you, but I didn't want to ask you a question. How does the inability of companies for appraisals and basically, if they kick the tires and be able to take a look at things actually affect the valuations?
Yeah, I think what you get into is people will be much more conservative about what they're willing to pay in a liquidation. So we try and get that information for them if we can. As liquidators, a lot of times we will go out and assess a situation, and a lot of times in person. We want to see that so we can see what the values might be. We can see what the removal situation might be. We can look at what expenses may be on a certain opportunity. So we are still doing some of that. A lot of times we're driving. We have employees all over the country. We're driving to avoid the airports. The plants are shut down, or we can get in there and look around pretty easily. And then of course we're practicing social distancing where we are and having our teammates wear masks. But we're trying to make it, just like we have for online auctions for a long time, as remote as possible. And certainly buyers are used to buying in online auctions now than they were maybe 15, 20 years ago. And for the most part, I'd say probably 80% of auction buyers already buy things on site, sight unseen. They just look at the photos and the description. They may call and ask a few questions, but they'll buy it without really going to visit the equipment.
So it really hasn't, what you're saying is it really hasn't affected the values of equipment sales then?
Yeah, from that perspective, the ability to inspect or look at the equipment, I don't think it's impacted it. Certainly the market, like Ryan was talking about, is having an impact. And I'll give a couple of examples of that in certain markets where the asset values are dropping just because the industries aren't as busy and there may not be as much investment in those industry verticals.
Okay, thanks.
So the other thing we're looking at Tiger, and this is the third point here, is essential industries. So we're really kind of focusing on, if we're going to spend our time and resources and make sure everyone's safe, we want to be focused on essential industries. And, one of the reasons for that is that, we want to get the assets that are being sold into the hands of people that can use the assets and help us either fight or recover from the coronavirus here. So, we're doing things mostly in essential industries, or really all right now as far as auctions and liquidations. And you can find these essential industries. There's federal guidelines, pretty easy to search essential industries, COVID-19, and you'll get a lot of resources. California has a really good website up with a PDF, and you could see all the industries that they consider to be within the state essential industries. And these are things, industries like healthcare, obviously, food and agriculture, energy, transportation, communications, media, and IT, a lot of critical manufacturing, obviously medical manufacturing for masks and those type of things, financial services, and a few others. So, if people have questions about that, that's certainly very easy to go and see that on California, and just search California Essential Industries COVID-19, and it'll pull up some nice resources for you. So that's where we're trying to focus our resources and time right now, and certainly get some of these assets that can be either used to help with the recovery or prevent it. So that's our kind of focus with that. A couple of things about the current buyer participation in auctions. We're seeing really kind of more machinery and equipment sales at auction versus, say, inventories or liquidations. Liquidations are a little bit slower. There's a little bit less sense of urgency with those sales, and inventory is just not moving quite as much as you see machinery and equipment right now. So that's one thing we're noticing. I'm sure the inventory and the liquidations will come back and be more focused, but right now it seems that buyers want to focus on auctions that have close dates and the certainty of sale that auctions provide. We have seen some pretty normal participation in our last sales. We've done a couple of audiovisual media sales over the past 3 weeks. Certainly very strong buyer participation and registrants in those sales. Prices have held up very well, maybe a 5% drop in prices than what we might have seen 3 to 6 months ago. We also had a small manufacturing sale, and those prices seem to stay up pretty well also. So there are buyers out there. The buyers are registering. We've got a food manufacturing sale coming up next week, and very strong participation from registrants and buyers so far in that sale. So buyers are out there looking for opportunities.
Has the volume dropped at all in terms of what the amount of product that you're liquidating at this point, or is it about the same as what it was before?
It's dropped a little bit. There are some auctioneers who are just waiting, and liquidators that are waiting to see how everything plays out. We are seeing, as Ryan talked about, just decision-making being delayed, as people want to kind of see how things are going to play out. And others just sometimes don't have the resources. They may just have their plant completely shut down. And so they don't have really anybody even on site to go and help with the liquidation or an auction at that plant, or even go out and assess it. So it is delaying things. I think we'll see a pretty large uptick in the amount of auctions and liquidations in the commercial industrial space, but that may take a couple, 3 months to play through here.
So if you had product if you had a plant to liquidate, do you think they ought to be doing it sooner, or wait until the crisis is over?
I think it's going to depend somewhat on the vertical, but from what we're seeing right now is there are buyers out there, they're participating. I think buyers sometimes think of these kind of crises as an opportunity to go buy and get a good deal. So they are out there and they're participating, and they're doing what they need to do to go buy things. I think just like at retail, if you see a lot of the same items coming to auction at the same time, that will likely depress prices. So, if companies are thinking about or on the edge of it, and then they're in a vertical that still remains strong, then it's probably better to do it sooner rather than later. And there are, some categories and assets that are having a pretty negative impact. A couple of them that we've been tracking, we certainly look at leading indicators like the PMI index to track manufacturing and some of the national truckload freight volumes. So transportation seems to have gotten a little bit weaker. We've tracked some comp sales on trucking, on trucks between February and the end of March, early April. We're seeing prices down on comparable items about 15 to 20% on the assets themselves, and certainly the national freight volumes are down as well. Energy equipment's another obvious one. Seen some comps on some oil field tanker auctions, comparables kind of last 4 months on forced liquidation values down about 30-40%. Not really surprising there, given oil prices are at $20 a barrel in the U.S. and you've got a lot of oil on the market, even with OPEC cuts coming. Just because you're getting a 1-2 punch there with too much supply and demand down 20-30 million barrels a day because of the coronavirus there. So it's that's another tough market, but AV, food processing, manufacturing, so far we've seen the values hold up. A couple other sectors that we're starting to see some distress in, certainly aerospace manufacturing. I think everybody's kind of familiar with the issues there. Oil and gas, obviously, the automotive sector on number of suppliers seem like they're having some distress, and there's just not a lot of automotive manufacturing going on right now in the U.S., and certainly the demand side is down, as Ryan talked about as well.
Okay. All right. You mind if we move on and talk to Chad from Armanino about quality?
Great. Thank you.
Sure.
Chad, can you tell us how the quality of earnings reporting is having an impact?
Sure. It's somewhat of a misnomer of quality of earnings. It's really more like measurement of cash burn and runway assessment. So this is really more from the context of selling a distressed company pre-liquidation. So if there's an opportunity for a distressed company to be bought out and it's still, operating. But number one, for some of the, while we're in this remote environment, in general, the calendar time for diligence has been elongated. And in order to, do as much stuff remotely as you can and schedule either the virtual type tours of assets and operations and getting that scheduled in. So a lot of buyers are going to have to, if they want to shorten the overall diligence timeline, a lot of times it was done in stages where you do financial first, then bring in legal, then bring in somebody else. Those will have to be kind of run in parallel to kind of shorten or mitigate the extended diligence time. The other part of that too is buyers have, are more sophisticated now and are, and a lot have lived through, 2008 and this is, completely different. However, they got a lot smarter. So a lot of this cash triage and analysis that they're doing on their own companies, they're going to expect that from the selling, the distressed companies in sale. So there's obviously a huge focus on just where the cash position of the company and how long of a life do they have left from a cash perspective. Financial projections are going to be completely, gone through with a fine-tooth comb. You simply can't go off of pre-COVID times and jump off of that. It's a brand new foundation that needs to be built and followed up through on the projections. The working capital in general is a real bear to measure right now, and the dust has not even come close to settling. So those top four are going on right now. I have some active deals that were well on the way pre-COVID, and we're trying to figure out this stuff now. And it takes some time to digest, and we have to be reasonably transparent with assisting the buyers understanding how we arrived at the assumptions and why we're using the assumptions. I'm going to skip over number 5. 6 and 7, also just kind of goes into what has been postponed. So yes, we're conserving cash now, or the company's conserving cash now as best it can, but what was put off and how, on the level of magnitude, what really needs to happen when they become more liquid from a cash perspective, and kind of just what is the catch up that's going to happen down the road. And then finally, outside of the financial space, everyone's going to be, asking for, disaster plans and a look back of how you've handled the crisis now and what you've learned from it and what you're going to be putting in place. So number 5, the EBITDA adjustment for COVID, that's going way down the pike. That's kind of future tripping, but going into next year or whenever things become normal again, that adjustment is going to be very tough to calculate, and there's going to be a lot of folks that will try to bury some non-COVID stuff, blemishes in that adjustment. So that adjustment has to be very well, thought through, and it's not a simple adjustment, just pretending that, March 15th through whenever didn't happen. So all these things, in addition to the remote environment, are going to kind of extend the diligence timeline.
Okay. Well, how about, so when you take a look at quality of earnings, then, I mean, how do you determine the impact, the long-term impact of EBITDA on a company. I mean, it's, obviously some companies are going to have more longer term, or I mean, even shorter term or longer term impacts based upon COVID. And how would those affect the valuations or the quality of earnings that you're putting together?
So the quality of earnings really almost needs to be rebuilt from what it is now and go forward what the new normal becomes. And I don't, no one really knows how quickly we're going to get back to normal, other than it's most likely going to kind of happen in stages and may depend on geography and or sector, obviously. So it's almost going to be like starting from scratch and looking at where the company is now, go forward. We may never get back to, depending on the situation or the sector, you may not really be able to just simply go back to pre-COVID times and say, okay, it'll take about a year for the dust to settle and the company is going to return to the, to the pre-COVID growth rates and EBITDA percentages. So it's all case by case and really has to be kind of rebuilt to a degree. And a lot of the stuff is just not known at this point. And same thing with just multiples, right? Purchase price multiples off of cash flow. It's very hard to tell because the lenders aren't sure on leverage ratios just yet.
Okay. So I'm checking to see if there's any other questions that people have for you, or in general, are there other questions that you have for any of the other panelists? Okay. Well, maybe I could actually, Chad, maybe I could ask you a couple questions if you don't mind as well.
Great.
In terms of, when you take a look at the management team's performance, how would you evaluate that, and how do you think that affects, the valuations or what happens during this crisis, and more of on a long-term basis? Is that taken into consideration at all?
Are you talking to Chad Z? Is that to me?
Z.
Yeah. So obviously, the management teams that have their stuff together and have been able to respond quickly and had very good communication with all the stakeholders and presented several different scenarios and had good scenario planning. It's a win. I mean, it's a big win, especially from like a private equity perspective. They have more faith in the management team and have, ultimately more faith that the company will turn around longer term. So that's one of the things that we are helping our sell side clients out with is really just not only doing the analysis, but making sure everything is being executed and communicated on a much more frequent basis. The other thing that we're assisting management teams with is the type of reporting and the type of communication is changing. So it's not just sending a board package at the end of the month. It might be doing informal reports every week with different KPIs that weren't traditionally included. So it can only help with maintaining a valuation or mitigating the lowering of a valuation and keeping the interest of buyers from a longer term perspective, having longer term faith in the management team.
And when you take a look at it, one other thing too, when you take a look at the management teams, a lot of people have applied for the PPP programs that are out there and some of the other ones. Have you seen that having what do you see? Has that actually helped liquidity in a lot of the companies, or potentially is going to help liquidity in a lot of these companies, or they're planning to use that liquidity in what type of ways to benefit the company?
So right now, it's really try to save as many jobs, right, and keep people in place. I don't think it'll be enough necessarily. So for companies that I have some companies that I'm helping out on the PPP side, they've received the funding, but we're still having forbearance talks with the senior lenders and with significant vendors on deferring payment. So I don't think PPP in of itself is going to necessarily, solve, is not the silver bullet. There are other options that are coming out for middle market companies and larger size middle market companies, such as the Main Street Loan Program. And I think, the final details, I think, are set to come out after April 16th. I think they're still receiving commentary all the way up until April 16th on the actual program itself. So there are the difference between that and the PPP, though, is well, one, you can get more money, but two is it's not forgiven. None of that will be forgiven from the Main Street perspective.
Okay. Chad Farrell, I think we have a question from Matt Grimes. How active have the ABL shops been in increasing or in scheduling appraisals in the last month?
Probably a better question for Ryan, who runs our appraisal team.
Oh, sorry.
That's okay.
Yeah, no, at all. Yeah, so we're not getting, it's funny, I can't actually give you a direct answer on that. We're getting a zillion phone calls as you'd expect. But almost strangely, I would say some lenders don't want to know yet what the full impact is, or really they just don't want to know what the impact is today. They want the economy to kind of reopen before they get new values. Because again, if asset trading today is going to result in a very low value, but in a couple months when the economy reopens and there's more certainty, then values will actually be higher than they would be as of today. So they're not extremely active at this minute, but I would say a lot of them are kind of putting the dominoes in place to get values updated in Q3 and Q4. So my expectation is come summertime, we are going to be unbelievably busy updating values.
Okay, another question I received, which is how much do you think a second, third wave of coronavirus will impact future values?
Oh, get out your crystal ball. I mean, this one is, it all depends on how much the overall economy reopens and how much assets trade, right? It's lesser about asset values are always reflective of what's going on in the economy, right? They're always reflective of where demand is for goods and the saleability of goods. So the longer we're cooped up, the more we're in our homes and the less economic activity there is, the more depressed values will be. And that's true now, and it's true if there's another wave in the fall, and it's true again if there's another wave in next spring, for example. So there's a pure correlation between when the economy or how active the economy is and asset values. So I can't quantify it, but I think the rule of thumb is going to be is the more open and free our economy is, the better the values will be.
And given that, do you think it will have a greater impact on equipment values or inventory values?
I think the two are correlated. And Chad Farrell, I'll give you my thoughts here, and then feel free to override me if you feel differently. But I think the inventory for which values are depressed the most is very likely to be correlated to the equipment related to that inventory. So so we know the toilet paper is in high demand, so we know equipment for toilet paper should have great value today. But let's just say, for argument's sake, that it's not. Like, for whatever reason, demand goes down, then you would expect the equipment to have lesser value as well, because the goods that equipment makes, or the value of those goods is correlated to the activity for those goods. Chad, do you disagree?
Yeah, I agree with that. I think the one maybe exception to that is looking at inventories that are maybe perishable. And I don't necessarily mean food goods, but things like high-tech manufacturing or some type of materials that the technology changes very quickly. So it changes every 3 to 6 months. So you might have inventory you've been sitting on, but there's new technologies out. So it basically renders it useless. So other than that exception, I would say, yeah, Ryan, I'd agree with you.
Okay. Okay. Well, I think we're kind of, Leslie, are we kind of, how much time do we have left?
We have 6 minutes.
Okay. I was checking to see if there's other questions that are out there. Okay. If there's not, maybe we could ask, I'll ask a couple other questions just for each one of the group as a whole. You know, what is your expectation of, how long do you think it'll be before we actually are given a release order from stay at home? Is it, I mean, there's been expectations of it being in the middle of May, I guess, is the last current one. Do you think it'll be longer or more sooner or later than that? We'll just go down the list. We'll start with Ryan.
Oh, I was really hoping I wouldn't have to lead on this one. Man, I don't know. I hope it's May, right? I think here's what I do know. One thing that you will note is actually missing from virtually all of the discussions in the media of when things are going to be reopened and what the modeling looks like is what's missing from all of the modeling is when the reopen date is. And so a lot of people have models for the curve, but they don't say very clearly what the assumption is for whether people will be out and about. And until those assumptions are 100% clear, well, let me preface this again. Let me restart. I think it seems to be that it's going to be a data-driven decision. The problem is, as far as I can tell, that the data is not clear. So until the data is clear, it's going to be very hard to predict the outcome. When people in their modeling, when it's clear to all of us in the modeling what the assumption is for stay at home, then it's going to be a lot easier to predict the outcome. So I'm hoping that consistent with the current modeling, that it's end of May. I'm hoping. I don't know if it's going to be, but I'm hoping.
Chad Farrell?
Yeah, I think it's going to be regional and how it's looked at. We certainly are seeing some states in the Northeast get together and see how they might open things back up. And there are certain areas in the U.S. that haven't been hit as hard. And then you come into issues about interstate travel and those type of things. So I think you could maybe see some places open up in early May. Others may take much longer. We certainly have some countries that are ahead of us in this curve that we can look at to see how they might be handling things. You could even look at Italy and China. It's been hit very hard and see how fast they recover and open things up and what that impact has. You've got countries in Europe. Denmark's opening back up this week, their schools and commerce and everything. Sweden has remained open. So there are some models we can probably look at and see what measures they are using to open up and how that might impact a second wave of the coronavirus coming on or not.
And Chad Z, what do you think?
I got it easy because the two other guys helped me out. So I agree with both their assessments. I do think it'll be regional. I think the time it takes to do a rollout type of strategy, though, probably has two things that go into it. One is the bickering that potentially will go on between the states and federal. And I think the testing, the type of testing, and how quick we can get, large full-scale testing of folks going back to work can, the quicker that happens, the quicker I think we can do a full-blown, back to work type scenario.
Okay. And and given that, how long do you think it'll take for consumer behavior to return back to normal again?
I'll go first on this one since I went last. I think there's certain behaviors that are going to be permanently changed. Certainly online and e-commerce has accelerated greatly, and certain services have kind of exploded, like the Instacart and Uber Eats and stuff like that. From what I'm hearing, and I don't know if this is a way to measure it or not, but from what I'm hearing, and it changes literally every week, but, the healthy M&A market, I'm hearing that it's really not going to come back until like really first quarter of 21, and with any sort of normalcy. So I don't know if that means, by then we'll be, kind of more in a back to normal, but I do think there's going to be some permanent changes that it's just a new normal. And that's what makes, figuring out the EBITDA of a company so difficult, is how much has the normal permanently changed.
And where do you see it, Ryan, on that?
I wholeheartedly agree with everything Chad just said. This is a scarring incident, right? This is not a little wound. This is a scarring incident. There are going to be behaviors that have changed for good, and particularly with consumers buying from the web. I think there's, the shift was already happening, and there's going to be a massive shift that I don't think is going to be undone in large part.
Okay. All right. I think I got a signal that our hour is up. So I wanted to thank all the panelists for joining us today, and giving us some insight into their industries and what they're seeing out there. And I'd like to thank all the people who've joined us in the audience for spending the time and listening to what we had to say. So I hope you guys stay safe out there, and and I hope your families and everyone else that is doing well.